Thanks very much for having me this morning. Our view is absolutely that credit investors are not being compensated for the risks in place at the moment in the credit markets. There is a stark dichotomy between the ease of financing in the private markets and the ease of financing in the public markets. We see public market credit spreads at the moment being the tighter end of their range when we exclude those extraordinary periods of QE and the structured credit boom pre-GFC. So in our view, the market is actually pricing in a very benign forward environment, which doesn't sit easily with the lower growth outlook that we have with higher for longer interest rates. And we already see actually the start of the demise of the credit cycle.
So let's unpack that further. You say you're beginning to see the start of the demise of the credit cycle. Where are you seeing it? Are you seeing delinquencies beginning to pick up? Is it just that company-specific, sector-specific cash flow issues? Is it credit tightening that's beginning to have knock-on effects on the sector? Where are you seeing those warning signs?
Yeah, it's a great question. I think we're seeing it in micro and macro factors at the moment. So firstly, the default rate is picking up from low levels, but it is picking up, and that is noticeable. The second part is recovery rates are coming in very low in this cycle. So if something does default, people are losing more money, which is always a strong tell. The other big part of the puzzle is how weak financing flows have been over the last year or so. So we do see things like loan officer surveys, etc., saying credit is harder to come by on Main Street. But also, even in the capital markets, we've seen less refinancing activity, a slower high yield and leveraged loan market. And all that really is saying is that the flows of capital aren't really coming in with new, fresh money to refinance that old debt. So a lot of the kind of sectoral issues you can then unpick beneath that. So we certainly see sort of deep cyclical issues in things like chemicals destocking, paper and packaging margins, secular shifts in TMT, etc., which then just interplay very badly with the amount of debt that companies have on the balance sheet. So if you're looking for cyclical slowdowns or sectors with secular issues, those kind of more macroeconomic factors sit badly. And what we've got to remember is that corporate defaults, they are a very lagging indicator. Companies don't take on board their first quarter of higher interest cost fixings and say, look, let's default. They may wait several quarters. They wait for suppliers to change terms, competitors to begin price wars and things like that before they actually consider restructuring their balance sheet. So what is telling is that we are seeing these slightly higher default rates and slightly lower recovery rates before the economy really rolls over.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.